China's whole economy is going to collapse and affect the biggest worldwide recession. The latest economic information emerging from China is exposing the country's serious weakness. The Chinese Communist Party is attempting to save the economy. However, the reality has already emerged. Cathie oversees nearly $20 billion and has rapidly recognized the agony that the world is going to face. Economists currently see the U.S. gross domestic product growth outperforming China for the first time in 50 years. So what's truly happening in China? This video will show China's fighting circumstances and the stunning information pointing toward the nation's collapse. Welcome to Bulls and Bears. If you're new to the channel, hit the like button and subscribe if you enjoy our content. Now, let's go back to the video. After China started to open its economy in 1978, the nation experienced unprecedented levels of growth. China's gross domestic product growth averaged a rate of generally 10% each year. This brought significant prosperity to Chinese residents. Over 800 million individuals got away from poverty. Medical care progressed tremendously, education became prioritized, and technological advancement accelerated. China's unmatched growth has driven the country to turn into a manufacturing powerhouse, respected by all financial experts. However, as all of you know, there's no free lunch. The reason behind China's unmatched prosperity is centered on its growing liabilities. When the economy flourished, the people who took out loans encountered a speedy appreciation in their net worth. This caused others to do the same, making the economy grow significantly faster. This allowed more Chinese residents to take out loans. The cycle represented a positive feedback loop that made China experience exponential growth. This model has worked for a long time. However, China's debt has grown to a point that isn't sustainable. China's government debt to GDP ratio has grown to more than 66%, which was built over many years of growth. The total public Chinese loan to gross domestic product has likewise followed this direction to more than 300%. This is practically 60% higher than the worldwide rate of debt to GDP, and it's practically double the U.S. non-financial corporate debt to GDP. Such a huge amount of liabilities is not sustainable, and China's new issues are revealing this. China has been endeavoring to carry out what's known as the Zero Coronavirus Strategy. The Zero Coronavirus Strategy provides China's government with a straightforward objective of zero coronavirus cases. The best way to get somewhat near this objective is to execute brutal regulations, which have extreme economic ramifications. Banks and economists worldwide have continuously cut their GDP forecast for China due to severe coronavirus regulations. More significantly, China's crackdown on over-leveraged organizations could induce something contrary to the positive feedback loop we discussed earlier, a negative feedback loop. Individuals defaulting on their loans cause the economy to slow down. That leads more individuals to default, which slows down the economy significantly. President Xi has a simple objective of common prosperity and has been executing a huge array of guidelines for this campaign. One of these areas is real estate. Real estate prices are a prime example of uncommon prosperity. Speculators have made a disproportionate amount of capital appreciation from increasing property prices. Xi is endeavoring to get serious about this by implementing new property taxes. Another strategy that Xi has been implementing to take action against real estate is the 3 red lines policy. The 3 red lines put a ceiling on how much debt property developers can have. These policies are causing housing prices to drop at incredibly fast rates. The volume of new home sales is also encountering a similar slump. New home sales at the beginning of May 2022 were down by around 33% in 23 significant Chinese cities. Real estate represents 25% of China's GDP, so a 33% drop in home sales would bring about a 9% drop in China's GDP. China's government recognizes the organization's impending catastrophe and has been doing anything in its power to prevent further collapse. While the U.S. Federal Reserve has been raising interest rates, China's government has been slicing interest rates to save its economy. China's loan prime rate for households and corporate loans is presently at 3.7%. This number is only expected to drop significantly as time goes on. The country recently cut its 5-year loan prime rate by the biggest amount since 2019. Most investors view this crash as an isolated failure that won't influence other countries. Contrary to this, China's economic collapse could make the whole world enter an extreme recession. The US Federal Reserve is raising interest rates and reinforcing the buying power of the dollar. This directly weakens the worth of the Chinese yuan, in contrast with the US dollar. China's weakening currency will lead its buying power to drop considerably while the Chinese economy is already crashing. China represented more than 18% of the worldwide GDP in 2021, so an unexpected crash in China's economy would cause worldwide weakness. Top this off with the fact that Europe is encountering decelerating economic growth, and we are plainly in a scary situation. Cathie compared the Fed raising interest rates to playing with fire, because it could intensify worldwide issues. The US bond curve recently inverted for the first time since 2019, which points to a coming recession. An inverted yield curve is when the 10-year Treasury bond yield is less than the 2-year Treasury bond yield. When the interest rate for a shorter time frame is greater than a longer time frame, this suggests that the near-term risk is more than a long-term one. In simpler terms, bond investors are anticipating extensive pain. An inverted yield curve usually goes before recessions in most cases. Europe and China are in troublesome waters. The Fed seem to be playing with fire. Global economies are incredibly delicate at the moment, and a crash in the US economy will twist every economy into terrible turmoil. The last worldwide recession was in 2008. When a large number of countries experienced economic weakness. However, the 2008 recession wasn't on a similar scale as our looming crisis. China's GDP was still growing in double digits during the 2008 worldwide recession. The remainder of Asia, Australia, and Africa likewise didn't encounter a significant decrease in their particular GDPs. Unlike 2008, our current circumstance incorporates most of Asia, Europe, South Africa, Australia, and America suffering. I've shown many charts about China's economy all through this video. However, those numbers could really be fake. China is known for having misleading economic data that covers economic disasters and overstates growth. A few Chinese cities have openly admitted to faking financial data. One northern industrial city in China named Baotao openly revised its economic report because of quote-unquote fake additions. One more city in 2016 that was known as the Chinese Manhattan exaggerated its income by 33%. This sort of false reporting could imply that China is now in a recession. However, we simply don't know it yet. Cathie thinks that if we saw the real numbers in China, there would be significantly more massive sales decreases in the property sector. She thinks that could eventually prompt lower oil prices temporarily. So considering this data, how could investors set up their portfolios to endure this slump? One simple method for remaining above water is to hold cash, but inflation will consume your capital. Investing internationally is likewise impossible, with both Asia and Europe suffering. One method to safeguard your portfolio in the coming months is to put resources into the US market. That could sound illogical. However, the US financial markets are still in the best position compared to the worldwide markets. Even though the US dollar is encountering huge inflation, it is remaining somewhat strong. The dollar index tracks the strength of the dollar compared to other currencies. This index has been on the upswing over the last year, despite high inflation. Investing in gold could be a phenomenal hedge, although a significant slowdown in inflation could lead gold prices to drop. My point is that each asset has disadvantages. In this climate, diversification in the best assets would be the best choice for bringing down volatility while keeping positive returns. One example of diversification could be 25% of cash, 5% in gold, 5% in Bitcoin, 40% in ETFs, and 25% in individual stocks. Such a portfolio probably won't get the most significant yields. However, you can still have the capital to purchase the dip while having long-term gains. If you're seeking to take on higher risk for higher rewards, putting resources into public growth stocks could be extremely worthwhile. A lot of venture capitalists turned out to be unquestionably bullish on public growth development stocks. We all know that public growth stocks have crashed immensely, with ARK Invest being the focal point. This has opened a vast range of opportunities to make 10 or even 20 times returns over the next few years. Public growth stocks are very volatile, and you should only invest if you're ready to see your portfolio trend downward for the short term. That being said, I have seen a few very rich people change their feelings about growth stocks and begin buying in. Tell me your opinion on China's looming recession down below. Do you feel that the US will be hit alongside China? If you enjoyed this video, hit that subscribe button, click on the notification bell to be updated on our new videos. See you in our next video!